AIM is the alternative investment market, and it's London's main small cap market for smaller companies. Now, we're all familiar with the FTSE 100 and the large companies such as BP and Tesco and the banks that are listed on there. But then if you look down, these are far smaller companies, many of which people have never heard of, with their share prices usually measured in only a few pennies per share rather than the pounds per share that you get for big companies. AIM has a reputation for being more volatile because clearly there's much less trading that goes on in these markets compared to the great swathe of liquidity you see for the heavily traded shares on the FTSE 100 and the FTSE 250. So it is, in a sense, a more volatile market. Of course, that does mean you get big gains and big losses, and it's worth bearing that in mind. But with increased volatility, it means you get what's called knee-jerk moves. So if a company, for example, a lot of small-cap oil and gas firms and mining companies are listed on AIM. So if you bear in mind that these companies stand or fall by whether they find new discoveries of commodities. So if you have a report from an oil company that says we were drilling a well in, say, the Falklands and we didn't find anything, then that's going to be very negative for the share price. And you'll see a very sharp move. So if you look at AIM, it is important to bear in mind that moves in either direction can be quite volatile. There are small cap indices in the States and in Canada and Australia, but of course they have their own elements that go with it. But I think the same elements apply in terms of volatility, because it's important to have an alternative investment market, because every company reaches a stage really where it needs outside investors that it can't get just through bank funding. And the sense of AIM and its sister markets is important, that you have that sort of area. But that, of course, means that opening up to private investors does allow room for sort of some issues in terms of funding, and that some investors can be quite badly burned by investing in AIM. So it's always important to do your research when investing in a company, look at its business and look at how it's expected to perform in the future. I think the wise thing would be to do your own research into the companies. The AIM was designed to be an easy market for people to enter, because with the FTSE 100 you have to have a certain size and also a certain number of free float in terms of the number of shares that are freely traded on the index rather than just being held by certain interests. So with AIM, those rules were relaxed to make it easier for companies to enter. Now, in a sense, this is a very good thing, that you broaden the base of the stock market. And when you have times of economic growth, as we saw before 2007, AIM did very well. But obviously in the harder times afterwards, a lot of companies left the market because of the cost of regulation. If you obviously list on the stock market, the public oversight is harsher than it would be for a private company. So a lot of companies found in the wake of 2009 that it was easier to become a private company and just draw their funding from other sources. But AIM does have its own regulation system and regulatory system overseen by the LSE, so it's not an entirely unpoliced market, but it is more important, I think, for AIM to really drill down into the companies you're looking at. It's a very broad coverage, really. I think the cut-off point really is around a £10 million market cap. So if all the shares together of a company are worth less on the market value than £10 million, it tends to be the fact we don't cover it, mainly because the reduced volatility, liquidity in these shares, they don't change hands quite so often as you would see for the FTSE 100 or the 250. So it's harder for us to hedge ourselves in that market with clients. And also because fewer clients trade them, there isn't that automatic hedging we get with bigger companies. So it's slightly more difficult for IG, and we can't always short them as well. We perhaps only offer the ability to go long rather than short as well, depending on the availability of the stock. In a company where, say, the share price is 5p, a spread even of 4 or 6p either side is quite a big move in the share price in percentage terms. So AIM shares are probably not ones for those people looking to move in and out of a market very quickly, because the shares can trade only a few times a day and you won't have that regular movement you would get with larger companies with greater share liquidity. It's more for the long-term investor to see how that plays out over weeks and months. I think it's, for trading AIM, is probably better for long term. You can see very knee-jerk reactions for companies on AIM if they announce results that are good or bad, even more so than you would for companies in the FTSE 100. So it's important to sort of try and be able to have a longer term view to ride out a sudden reaction that if an AIM company reports results that aren't as good as expected, you can often see a 15–20% drop in their share price, which for a company worth 5 or 6p can be quite big. So it's worth not just approaching it from a longer term perspective, but also diversifying from just a few AIM companies. If you own a number of them, it's less likely that you will suffer heavy losses unless you'll spread your risk around.